So we want to look at a few other general considerations. Foreign taxes are often expressed in terms of a foreign currency, so be they euro or pound sterling, but all amounts must be converted to US dollars, depending on the taxpayer's functional currency. So generally, US-based taxpayers' functional currency must be in US dollars. Non-US based taxpayers may have their functional currency in the currency of their residence. So if you are living in Europe, you may adapt your functional currency to euros. However, all filings with the service must be converted to US dollars, and all payments made to the IRS in a currency other than US dollars will be converted for the IRS at the then prevailing rates by the bank processing the payment, without reference to the date the payment was received by the IRS. So any changes in the value of your foreign currency will either be in your favor or against you, but the IRS does not carry the foreign currency exchange risk. The taxpayer does. Tax treaties may allow for US-sourced income to be resourced to foreign-sourced income in certain circumstances. So, for example, a taxpayer who is living and working in the United Kingdom but is assigned, say, for 3 months on a project in the United States and then returns to the United Kingdom may, under the US-UK tax treaty, be able to recharacterize the source of that 3 months' worth of income to be UK-sourced income. So resourcing, which can allow for this income to be recategorized and thus allowing it to qualify for an exclusion or a credit. However, the resourced income must be taxable as resource income by the foreign taxing authority. State income tax. Taxpayers leaving a US state may wish to terminate their residency of that state, particularly if there's a state income tax. A taxpayer receiving income, bonuses, etc., while non-resident of that state is not liable to that state for state income tax. The taxpayer must be careful not to take actions or make declarations contrary to their claim of non-residence. There's a now famous case of a taxpayer from Montana who moved to Singapore. When he returned after being in Singapore for many years and took residence up again in Montana, he filed his Montana state tax return, and the Montana authorities came after him for missing tax returns and missing income tax. His claim to be resident in Singapore was undermined by his choice to claim residence on his hunting license, thereby saving him about $30 a year on his hunting license fee, being the difference between a resident and non-resident hunter. So you have to be very careful that you don't make any declarations contrary to your claim of non-residence. You may wish to deregister from the voting registry. You might want to give up your driver's license, other things like that. Estate taxes may also be levied by a state if you have not established your domicile out of that state. So domicile and the rules around domicile are beyond the scope of this webinar, but it's certainly something to be considered. Elections. The taxpayer elects to exclude their foreign income by filing a Form 2555. You can be deemed to revoke that election by claiming the foreign tax credit instead of the foreign earned income exclusion. If you have claimed the foreign earned income exclusion and you have additional income on which there is foreign tax for which there could be a credit, that will not cause the election to be deemed to be revoked. And the reason this is an important point is revoking an exclusion election prevents the taxpayer from making the election again until the 6th tax year after the tax year for which the election was revoked. So if you revoked your election, even by accident, in 2010, the 6th tax year after that would be 2016. However, you can apply to the IRS for permission to make the election within that 6-year period, and they may grant it if there are significant changes in your circumstance, such as you have moved to a different country. So let's look at an example of this. A taxpayer living in the Cayman Islands would choose the foreign earned income exclusion, as there's no income tax payable in the Cayman Islands, so there would be no foreign tax to credit. However, the foreign tax credit, which can be carried forward, may be preferable if the taxpayer moves to Germany, where the individual income tax rates are higher than that in the US. If the taxpayer moves to Germany and revokes the election to exclude the foreign earned income, they'll use the foreign tax credit. But what if after 2 years they moved again to Dubai, again a country with no income tax? Then they will want to petition the IRS for permission to re-elect the exclusion, since there will be no foreign tax to credit. The Tax Cut and Jobs Act. Talk briefly about some of the impacts of the Tax Cut and Jobs Act. The Tax Cut and Jobs Act claimed to move the US to a territorial tax regime. It made significant changes to the international taxation of US companies and US persons. Under the old law, corporations would keep their foreign profits outside of the US, and they were only taxed when those profits were repatriated into the US. It was often noted that Apple had more than $250 billion of profits outside the US, on which it would only pay taxes when it brought them home. So for US taxpayers owning and controlling foreign corporations, there are significant changes to the use of foreign tax credits. Under the new law, profits will be taxed each year as they arise. So it's still taxed on a worldwide basis, but now the deferral mechanism of not being taxed until it was repatriated has been removed. For controlled foreign corporations, and we'll define those in a moment, a new tax on what's called Global Intangible Low-Taxed Income, or GILTI, has been introduced. A controlled foreign corporation is a corporation with a U.S. shareholder, so that's a U.S. shareholder who also owns more than 10% of the vote or value of the corporation, and where more than 50% of the voting power or the value is represented by U.S. shareholders. So a corporation that has 10 U.S. shareholders or 12 U.S. shareholders, each of which only owns 5%, unless they are familiarly attributed, would not create a controlled foreign corporation. A passive foreign investment company is never a controlled foreign corporation. A closer look at GILTI. Some of the defined terms. QBAI, Qualified Business Asset Investment. This is an equivalent to a Section 167 depreciable asset. And under GILTI, a 10% rate of return is allowed for QBAI assets. Under GILTI, there's a concept of CFC tested income. CFC tested income is CFC gross income less effectively connected income and subpart F income and subpart F income excluded under the high tax exemption, dividends from related CFCs, and foreign oil and gas extraction income. So the sum of all of those is extracted from gross income to produce CFC tested income. GILTI, the Global Intangible Low-Taxed Income, is the net CFC tested income that exceeds the allowed 10% return on the adjusted basis in depreciable assets, the QBAI, less any interest expense. So U.S. corporations owning CFCs will pay 21% tax on their subpart F income and continue to avail of any foreign tax credits, a 10.5% GILTI tax on their GILTI income, with an allowance of only 80% of their foreign tax credits, and we'll see how we arrive at 10.5% in a moment. Any remaining income will be fully exempt from U.S. tax. For many companies with subsidiaries and foreign tax regimes with tax returns above 13.125%, or where the 80% of the allowable foreign tax credits will cover the 10.5% GILTI tax, they will pay no U.S. tax on foreign earnings.